Welcome back to the Deep Dive. Today, we're taking a really close look at KIP Real Estate Investment Trust, KIP REIT. For quite a while now, KIP REIT's story has been all about, well, aggressive growth, right? Buying up properties, expanding the portfolio pretty dramatically over the last year or so.
That's right, a lot of activity.
So now we're diving into their latest numbers. This is for Q1 of their fiscal year 2026, the period ending September 30th, 2025.
And this check-in is, I think, really crucial. Last time when we looked at their Q4 FY 2025 results, we spent a lot of time highlighting this core tension.
Yeah, I remember that clearly.
They had this massive top-line growth, adding big names like DPulse, TF Value Mart, really expanding fast. But, and this is the big but, it came with rapidly rising costs.
Those costs were eye-watering, weren't they?
Yeah.
We pointed out, I think, utilities were up almost 120% year-on-year in Q4,
Yeah.
and management fees, over 400% jump.
Just huge numbers.
Yeah. So the question we kind of left hanging was, well, is this sustainable? Can KIP REIT's growth strategy actually keep outpacing these ballooning costs? Is it a race they can win?
Exactly. And that's really our mission today. We need to break down these Q1 results. Is the expansion strategy actually, stabilizing financially? How are the margins holding up?
And are these new acquisitions genuinely adding value or just adding sort of expensive bulk as they push towards that big RM 2.0 billion AUM target?
Precisely. Are they accretive in the true sense?
Well, looking at the headline number, it certainly screams success, at least for this first quarter. KIP REIT's realized net profit, the actual cash available for distribution, it surged a really dramatic 73.2% compared to last year, hit RM 17.5 million.
Wow, okay.
Analysts are already calling it a strong start to FY2026.
Yep.
So on the surface, it looks like the expansion is paying off big time, doesn't it?
It does on the face of it. I mean, a 73.2% jump in realized profit. That's extraordinary. It definitely suggests the new assets are generating cash flow very effectively and maybe overwhelming those cost pressures we were worried about.
There's always a but, isn't there?
Well, we need to look under the hood, right? What specifically drove that huge surge? And can they keep that momentum going without just constantly buying more stuff?
Okay, so let's get into it. Section 1, headline performance and, crucially, the sustainability of that distribution. All right, start at the top. Gross revenue, GR. For Q1 FY26, it jumped sharply, 52.6% year-on-year. That's RM 40.8 million.
Huge jump.
And net property income, NPI, that's revenue minus the direct property operating costs. It kept pace pretty much. Surged 51.1% year-on-year to RM 29.7 million.
Okay, now that symmetry is actually quite impressive. You've got GR up 52.6%, NPI up 51.1%. I mean, those rising operating costs, while definitely still there, didn't really erode the NPI margin significantly compared to the revenue boost.
So the new properties came in pretty clean operationally. Or maybe the older KIPI malls are managing costs better.
Could be a bit of both. It suggests either the newly integrated assets are efficient, or, the existing 7 KIPI malls are tightening their belts effectively enough to maintain that overall margin, even with inflation. It's a good sign, operationally speaking.
Let's try and pinpoint the drivers of that massive revenue leap. We know the original 7 KIPI malls were mentioned as doing better organically, but, I mean, a 52% jump? That has to be the acquisitions, right?
Oh, absolutely. When you see growth like that year on year, you're looking at the full impact of major acquisitions hitting the books for the entire quarter. We're talking DPulse, TF Value Mart fully contributing now, plus the newer income streams.
Like the Cheras Jaya industrial property?
Yes, and KIPI Maldissa Coalfields and the Bintulu industrial property, which just came online recently. This is where that aggressive buying strategy really starts showing up in the cash flow figures. It's the payoff quarter, in a sense.
Okay, but here's where we need to be careful, and this gets to the heart of the acquisition-led growth model. If we compare this quarter, Q1 FY26, to the previous quarter, Q4 FY25, the growth is much, much slower.
The sequential numbers. Right.
Yeah, gross revenue only nudged up 2.2% quarter-on-quarter. NPI was a bit better, up 5.9%.
And that contrast tells the whole story, doesn't it? The massive 52% year-on-year figure is comparing today's much larger portfolio to last year's smaller one. It's almost apples and oranges because of the acquisitions.
Right.
That modest sequential growth, the 2.2% QOQ on revenue, that's closer to the true underlying organic momentum, plus maybe the very tail end of integration effects. It really confirms that portfolio expansion, just adding more income-generating assets, was the overwhelming driver of Q1's big year-on-year success.
So they're kind of on a growth treadmill now, To keep showing those big year-on-year numbers, they need to keep acquiring.
Pretty much. If they want to post, say, another 50% growth in Q2 FY26 compared to Q2 FY25, they need to have closed and fully integrated several more major acquisitions during Q2. Otherwise, that growth rate naturally slows right down. It's the nature of this strategy.
Okay, let's circle back to that massive profit number then. The 73.2% year-on-year surge in realized profit. Our first big question was, how much of that was genuine organic improvement in the original malls versus just, the accretive effect of bolting on new assets?
Well, the evidence points strongly towards the new assets doing the heavy lifting. Think about it. NPI grew 51.1% year on year, but realized profit grew even faster at 73.2%.
Okay, so what does that difference tell us?
It tells you that the new assets, like KIP Coalfields and the Vintelu industrial property, were likely bought at yields that were very favorable compared to the cost of the debt KIP REIT used to buy them. They're adding profit at a faster rate than they're adding just gross income.
Ah, so highly accretive deals.
Exactly. Suggests a good margin of safety built into those acquisitions. The sheer volume and profitability of the new assets are basically overriding any slower organic growth or cost pressures in the older malls. Volume is king here for now.
And that success flows directly to the unit holders through the distribution per unit, the DPU. They declared 1.80 sen for the quarter. That's up 18% year on year.
Pretty solid increase.
Which translates to a yield of about 8.3% based on the recent price. That's attractive. But given we know costs are rising, borrowing costs, management fees, how confident can you, the listener, be that they can keep up this kind of DPU growth?
Well, that confidence really hinges on that huge 73.2% profit surge acting as a buffer. We know borrowing costs were up 25.2% year on year, management fees up 37.3%. If KIP REIT had only managed, say, a 20% profit jump, they'd be struggling to maintain DPU, let alone grow it by 18%.
Right, the math wouldn't work.
Exactly. So the fact that realized profit grew so strongly is the proof point, for now. It shows the income from the new acquisitions is robust enough to easily cover the higher operating and financing costs and still leave enough extra cash to boost shareholder returns significantly. Management feels confident because basically the recent deals are working very well. They're generating cash well above the cost of financing them. Okay, now we really need to look at the portfolio itself, the scale and the quality, because the pace of expansion has been, well, relentless.
Yeah, it feels like every quarter there's something new.
KIP REIT now reports 18 income-generating properties. That's up from 14 just a quarter or two ago. And this has pushed their assets under management, their AUM, up to RM 1.7 billion.
18 properties. That's rapid growth. 5 completed or approved acquisitions in a relatively short period. When a REIT moves that fast, the worry is always, are they sacrificing quality for quantity? Is there a risk of dilution?
That's the standard concern, definitely. How do they ensure this breakneck pace doesn't just water down the quality of the overall portfolio, especially when they've historically had such high occupancy?
And what is the occupancy rate now?
That's the key operational metric you can't really fudge. The source quotes an exceptional portfolio occupancy rate of 98.3% as of the end of Q1.
Wow, 98.3% across 18 properties. That's incredibly high.
It is, and it's actually up 3.9 percentage points compared to the same time last year. Management talks about disciplined execution and sticking to yield-accretive opportunities. It suggests they're laser-focused on their niche community retail, essential services where demand is just consistently strong. That helps avoid buying assets with vacancy problems.
Okay, let's zoom in on that retail segment then. It's still the bulk of their business. The central region in particular looks like a powerhouse. Delivered nearly half the total revenue this quarter. And the NPI growth there was frankly staggering. 203.4% year-on-year increase in the central region's NPI. What on earth is driving that kind of outperformance?
Yeah, 203% is a massive number. It's really a combination of things working together perfectly. First, it's the full impact of integrating those big central region acquisitions like Depols and the newer KIP Coalfields. They're just large contributors now, fully in the mix.
Okay, so new assets driving a lot of it.
A big chunk, yes. But second, it's also strong performance from their established central assets, places like KIP Senawang, Bangi, Kota Warasan. These malls serve really dense local communities, and they've been doing asset enhancement initiatives, AEIs like the facelift at KIP Bangi you mentioned, improving the property, the tenant mix that secures better rents.
So it's acquisitions plus optimizing the core assets.
Exactly. That combination is driving that huge regional NPI jump.
And speaking of optimizing, let's talk about KIP Tampoi down south. They're in the middle of a major AEI there too. How does that fit into the picture? Is that about organic growth alongside the buying spree?
The Tampoy facelift is a perfect example of investing in the existing portfolio. As of early October, it was about 40% done. It's a RM 22 million project overall. Critically, it's adding 10,000 square feet of new lettable space, the NLA, and upgrading the food options and general look and feel.
So generating more rent from the same building, essentially.
Precisely. These organic upgrades are vital because they boost the property's own income potential without needing massive external debt or new equity. It makes sure the older assets don't get left behind and can still contribute to growth and justify asking for higher rents later.
Which brings us neatly to that interesting trade-off. Occupancy versus rental reversions. We have this amazing 98.3% occupancy, and yet they're targeting pretty ambitious positive rental reversions for FY2026, aiming for 5% to 10% increases on renews leases.
Yeah, that's a bold target.
How do they manage that? Isn't there a risk that pushing for higher rents could push tenants out and hurt that fantastic occupancy rate?
Normally, yes, that's the tension. But this is where having 98.3% occupancy gives them incredible leverage. Think of it like a completely sold-out concert.
Okay.
If you're the venue owner, you can charge a premium for the few remaining seats or for the next show. If KIP REIT only had, say, 80% occupancy, they'd have to offer discounts to fill space. But at 98.3%, they know tenant demand is incredibly strong in their niche. If one tenant balks at a 5% increase and leaves...
There's likely someone else waiting to take that spot.
Exactly. The high occupancy, plus what they describe as steady tenant sentiment in their community-focused malls, suggests tenant demand is pretty inelastic right now. It gives them the confidence to push for those higher rents and achieve real organic growth, not just growth from buying things.
Okay, let's switch gears a bit. The industrial segment, it's newer for them, but it's accelerating. Gross revenue up nearly 28% year on year. They've added assets like the one in Bintulu. What's the big picture here? Is the long-term plan for industrial fundamentally different, maybe offering better risk-adjusted returns than retail?
I think the industrial push is definitely strategic. It's partly diversification, but it also offers a different kind of return profile compared to their traditional community retail.
How so?
Well, community retail, their core strength, it relies heavily on footfall, active management, dealing with lots of tenants, often on shorter leases. It's more exposed to consumer spending ups and downs.
Right, more hands-on.
Industrial properties, especially logistics and warehousing, which seem to be their focus, offer something else. Stability, predictability.
Because of longer leases?
Partly, yes. Industrial leases are often much longer, 5–10 years sometimes. And crucially, they're frequently structured as triple net leases.
Triple net meaning?
Meaning the tenant, not KIP REIT, the landlord, is responsible for paying most of the operating expenses. Property taxes, maintenance, insurance, sometimes even utilities. This shifts a lot of the operational risk and cost volatility away from the REIT.
Ah, I see. So KIP REIT just collects the rent, more or less.
It's a bit more complex than that, but yes, it leads to very predictable cash flows and generally higher MPI margins compared to retail, where the landlord bears more of those costs. So the vision seems to be a hybrid model. Get the volume and community connection from retail, get the stability and income visibility from industrial. It helps balance the risk profile as they scale up towards that RM2 billion AUM goal.
Okay, so the income side looks strong, driven by these acquisitions. But now we have to flip the coin and look at the costs. This is where that tension we talked about really comes into play. Borrowing costs, for instance, up significantly, 25.2% year-on-year in Q1.
Yeah, that's a hefty increase. And it's a direct result of how their debt is structured and, of course, the acquisitions themselves needing funding.
We noted last time that a big chunk of their debt, I think it was around 61% back in Q4, was floating rate.
Exactly. And for listeners, floating rate debt means the interest payments go up or down pretty much in line with the central bank's benchmark rate, the OPR here. So if the OPR goes up, their borrowing costs rise almost immediately. That 25.2% jump really shows how exposed they are to interest rate movements.
Management did mention some savings because the OPR had actually dipped slightly, but that 61% floating exposure still feels like a vulnerability, doesn't it? Are they actively hedging this risk? The reports mention prudent capital management, but what does that actually mean in terms of concrete steps? Are they using interest rate swaps or anything?
That's the million-dollar question, isn't it? And it's probably the biggest area where we lack clear detail. REITs can use financial instruments like interest rate swaps to effectively fix the rate on a portion of their floating debt, protecting themselves from future hikes.
But KIP REIT isn't explicitly saying they're doing that, or to what extent?
Not in the materials we've seen for Q1. We see the result, the 25.2% cost increase, but not the specific hedging strategy, if any significant one is in place. beyond just benefiting from any temporary OPR dips. It does seem like they might be relying heavily on the idea that future income growth from new assets will simply continue to outpace any rise in debt costs.
Which is a bit of a gamble on interest rates staying stable or low.
It carries that risk, yes. If rates were to unexpectedly spike upwards, that high floating rate percentage could squeeze margins and impact DPU sustainability quite quickly. It's a key risk factor for investors to watch.
Okay, let's look at their gearing or leverage.
Yeah.
After all the buying, and they did some private placements earlier to raise equity too, where does their gearing stand now?
As of September 30th, 2025, their gearing ratio was 38.55%.
38.55%. How does that stack up?
That's actually quite healthy. It's comfortably below the regulatory limit, which is 50% for Malaysian REITs. And importantly, it gives them quite a bit of headroom for more borrowing if needed. They've managed to fund billions in acquisitions without over-leveraging the balance sheet, often using that mix of debt and equity.
Right. They didn't just pile on debt.
Yeah.
So the target is RM 2.0 billion AUM. They're at RM 1.7 billion now. Gearing is at 38.55%.
Sure.
How do they fund the remaining RM 300 million gap, especially those pending industrial deals in Port Klang and Johor, and how high are they willing to let gearing go?
They basically have two main options to bridge that gap. Option one, more debt. It's generally faster and cheaper if rates stay favorable. But using only debt would push gearing up maybe towards the mid-40s, which reduces their flexibility later on.
Okay, option two.
More equity, things like further private placements or maybe even a rights issue. This keeps gearing lower, which is less risky from a debt perspective, but it dilutes existing unit holder stakes and can take longer to arrange.
So probably a mix.
Given their track record, a combination seems likely. As for how high they'll go on gearing, managers focused on long-term stability usually prefer to stay below, say, 45%. Being at 38.55% now means they can probably absorb those pending Port Klang and Johor deals using mostly debt without hitting alarm bells immediately, but the final gearing level will depend on getting those deals done.
Now let's tackle the management fees. They also rose sharply, up 37.3% year-on-year in Q1. That sounds like a lot, but we need context, right?
Yeah.
How does their fee structure work, and does this increase actually align with unitholder interests?
This is always a sensitive point for REIT investors, but you have to look at the structure. KIP REIT's manager gets a base fee, which is 0.8% of the total asset value, the AUM, and they get a performance fee, which is 3.0% of the net property income, NPI.
Okay, so both parts of the fee are linked to things that grew significantly.
Exactly. AUM jumped to RM 1.7 billion, so the base fee went up. NPI surged 51.1%, so the performance fee went up. A 37.3% increase in the total management fee is therefore pretty much expected based on that structure and the portfolio's growth.
And the alignment check. Does it track with profit?
That's the key. The management fee grew 37.3%. But remember, the realized profit for unitholders grew by 73.2%. So yes, the manager's getting paid more, substantially more, but they delivered even greater profit growth to the unitholders. In this quarter, at least, that alignment seems pretty strong. The performance fee element ensures they're incentivized by NPI growth, not just asset size.
But isn't there still an incentive from that base fee, the part linked to AUM, for management to just chase size, to hit that RM 2 billion target, even if a new property isn't super profitable right away?
That's the inherent structural tension in almost all external REIT management structures, yes. The base fee does reward growing the asset base. However, the performance fee tied to NPI acts as a counterbalance. If they buy a huge low-yielding asset just to boost AUM, the base fee goes up, but the performance fee might not, or might even drag down the average.
That's it.
The fact that profit growth, 73.2%, far outpaced fee growth, 37.3%, this quarter suggests they are currently prioritizing profitability over sheer size. But yeah, that incentive to grow AUM is always there in the background. It's something to keep an eye on.
Okay, one last point on the financial side. External factors. There's the new 8% sales and service tax, SST, on commercial rentals. Management said they expect minimal impact. Why so confident? Can they just pass it on?
Their confidence seems to stem entirely from their strong operational position. Again, it comes back to that 98.3% occupancy rate.
Landlord's market.
Pretty much. When your properties are effectively full, you have significant pricing power. If a tenant complains about the 8% ST making their total occupancy cost higher, KIP REIT is in a strong position to say, well, demand is high. This is the new cost reality. The factors they mention, improving footfall, solid tenant sentiment, and their essential services niche, suggest they believe tenants need their spaces and will ultimately absorb the tax pass-through. They don't expect it to cause vacancies or major pushback. Looking ahead, the CEO's comments really frame their strategy. They talk about scaling strategically while enhancing income visibility. And there's this constant refrain about commitment to sustaining stable distributions. The whole outlook is built on making this scaling plan work smoothly.
And the big headline target is hitting RM 2.0 billion in assets under management by 2027. They're at RM 1.7 billion now. That leaves that RM 300 million gap to close in, what, less than 2 years.
Yeah.
What's the concrete plan to get there?
It looks like a mix of things already in motion and perhaps some things yet to be announced. They'll get some uplift from organic growth, like the Tampoi AEI adding value, but the bulk of that RM 300 million has to come from acquisitions.
Which ones are locked in or nearly there?
Well, we know they completed KIP Maldissa Coalfields, KIP Kuantan, and the Bintulu industrial property during Q1. Just after the quarter ended, in October, they completed the Pasir Gudang industrial asset. They also have approvals for a cluster of retail properties in Kuantan.
Okay, so those completed and approved deals probably cover a decent chunk of that RM 300 million.
Yeah.
But what are the risks to hitting that 2027 target? You mentioned delays earlier.
Yes. Those pending industrial deals are the main execution risk right now. While they've closed several deals quickly, the large Port Klang and Johor industrial properties have faced repeated delays. The conditional period kept getting extended, most recently noted as until August 28, 2025, though that date seems to have passed, raising questions about their current status.
So delays signal potential problems: due diligence, financing, regulations.
Could be any of those. When big deals get repeatedly pushed back, it suggests hurdles. Finalizing these two acquisitions smoothly and relatively soon seems pretty crucial for hitting that RM2 billion target on time without having to suddenly find and vet completely new, large assets, which would slow things down considerably. The roadmap is there, but there are definitely potential potholes.
So summing up this section, operations look resilient with high occupancy, the strategy is clear scale up, but hitting the timeline depends heavily on executing those delayed industrial deals without further hiccups.
All right, let's try and pull all this together, the fantastic growth, the high occupancy, but also the rising costs and execution risks into our financial moat scorecard. How strong is KIP REIT's competitive advantage right now?
Okay, the verdict.
For KIP REIT, based on these Q1 FY2026 results, we've assigned an overall score of 7 out of 10. That earns it a strong moat designation.
7 out of 10 is very solid, especially for a REIT in the middle of such a big transformation. Let's break down why it scored that high. What are the key strengths, the moat drivers?
Okay, 3 main things stand out. First, operational efficiency. We gave that an 8. This reflects that strong net property income margin of 72.2% we discussed. Even with rising costs, keeping margins at high shows they're managing their properties very effectively day to day.
Good efficiency. What's next?
Second, and this is probably the most important factor right now, pricing power. That scored an exceptional 9 out of 10.
Wow, a 9. Based purely on the occupancy.
Almost entirely, yes. That 98.3% occupancy is just phenomenal in the retail REIT space. It gives them immense market leverage. Combine that with their confidence in achieving 5% to 10% positive rental reversions. It confirms they can dictate terms, pass through costs like the SST, and generally defend their income stream from external pressures. Occupancy is power.
Makes sense. And the third strength?
Growth execution, which scored an 8. This really speaks to the success of their strategy so far. The fact that they managed to acquire and integrate several major assets, leading directly to that huge 73.2% surge in realized profit, proves they're actually doing what they set out to do, expanding effectively and, crucially, profitably. That's not easy to do at this speed.
Okay, so strong efficiency, near-perfect pricing power, and proven growth execution drive the high score. But it's a 7, not an 8 or 9. What's holding it back? What's the main weakness or limiting factor?
The limitation comes down to financial flexibility, which we scored a 6.
And this brings us back to the debt and costs again.
Exactly. While the gearing level itself, 38.55%, is perfectly fine right now, that 25.2% jump in borrowing costs and the significant exposure to floating rate debt, still likely around 60%, introduce a level of financial volatility. Their high-growth model depends quite heavily on accessing capital relatively cheaply. This reliance makes their financial structure inherently less flexible, less resilient to sudden shocks compared to peers who might have more fixed-rate debt or lower leverage targets. That dependency caps the overall moat score.
Understood. Now, what about the wider market? How did analysts react to these Q1 numbers?
The consensus seemed to be pretty positive, generally seeing the results as in line with expectations. The Q1 earnings represented about 26% to 27% of their full-year forecast, which is right on track.
And the recommendations, still positive.
Yes, the analysts we saw, like TA Securities and CIMB Research, both maintained their buy recommendations. They clearly see the growth momentum as strong enough to overcome the cost headwinds, at least for now. They're focusing on the immediate positive impact of the acquisitions on cash flow and DPU.
Do they have specific price targets?
TA Securities had a target price of RM 1.09 and CIMA Research was at 95 cents. With the share price around 87 cents at the time, both targets suggested decent potential upside on top of that attractive 8.3% dividend yield. So the market view seems to be that the growth story is credible and will continue to translate into good returns for unit holders.
So for this quarter at least, the impressive realized income seems to have won out over the execution and financial risks in the market size.
So let's wrap this up. Our deep dive into KIP REIT's Q1 FY 2026 shows a company that's, well, firing on most cylinders right now. They emphatically answered the question from last quarter. Yes, for Q1, their aggressive growth strategy did successfully outpace the rising costs.
That 73.2% jump in realized profit is hard to argue with, and the 18% DPU increase flows directly from that. Operationally, they look solid too, that 98.3% occupancy is the bedrock, giving them the pricing power they need.
Absolutely.
Yeah.
But, and it's a significant, but the core tension we identified hasn't gone away. It's still the defining characteristic of KIP REIT. They are executing this massive expansion, largely fueled by debt, aiming for that RM2 billion AUM target. And they're doing it successfully for now, but the headwinds are real and persistent.
Rising borrowing costs are a fact.
Mhm.
The high floating rate exposure is a vulnerability. And those delays on the pending acquisitions highlight the execution risk that comes with such an ambitious plan.
Right. Their current success proves the recent acquisitions were good deals, highly accretive, generating cash well above their financing costs. That's created a strong buffer. But that buffer depends on continued successful execution and, importantly, on the cost of capital not spiraling upwards. That 60-odd% floating rate debt makes them sensitive, and they will need more funding soon to hit that RM2 billion target.
Which brings us to our final provocative thought for you, our listener, to ponder as you look at KIP REIT.
This strategy is delivering high growth and high yield right now, no doubt. But it's fundamentally dependent on the financial environment.
So the question is, how much of KIP REIT's continued, really extraordinary success hinges entirely on factors outside their direct operational control specifically, on the continued availability of relatively cheap capital and stable, or at least predictable, interest rates? Is it more about financial conditions than just their undeniable skill at running community malls?
It's something you really have to weigh. That fantastic 8.3% yield and the huge profit growth are very tempting. But you need to balance that against the execution risks of funding and integrating the next batch of assets, especially if borrowing costs climb further or those deals face more delays. Managing the balance sheet, managing that cost of capital, that's going to be the absolute critical factor for KIP REIT in the quarters ahead.
Definitely something to think about. Excellent analysis as always. Thank you for joining us for this deep dive into KIP REIT's Q1 FY 2026 performance. We'll catch you on the next one.
Stay well informed, everyone.